morning, everyone, and welcome to RRAR's Government Affairs and Advocacy Forum that's sponsored by our Government Policies and Issues Committee. My name is Jordan Forrest-Strally, and I am RRAR's Government Affairs Director. Thank you so much for taking the time to join us today to hear about COVID-19's effect on housing nationally and here at home. Before I introduce our guest speakers, I want to go over a few housekeeping items with you guys. This webinar will be recorded and we're going to make it available on our website by the end of the week. You will also be sent a link to that recording as well as any resources that are provided by our guests. We'll get all of that to you by this Friday. If you guys have any questions throughout the presentations, you can feel free to utilize the Q&A feature. Our staff is going to monitor those and we will address the questions to our guests at the end of the presentations today. So this morning, we are joined by two amazing speakers. First, we are going to hear from Dr. Jessica Lautz, who will provide a national perspective. Jessica is the Vice President of Demographics and Behavioral Insights at the National Association of Realtors. The core of her research focuses on analyzing trends for both NAR members and housing consumers. Through management of surveys, focus groups, and data analysis, she presents new and innovative ways to showcase results. Following Jessica's presentation, we'll get to hear from Lorena McDowell. Lorena McDowell currently serves as the Director of the Department of Housing Affordability and Community Revitalization for Wake County. McDowell began her work as a community advocate in the early 2000s, helping to serve in winter shelters and soup kitchens. In late 2018, McDowell came to Wake County to raise and lead the county's new Department of Housing Affordability and Community Revitalization. In this role, she and her team are responsible for efforts across the spectrum of affordable housing, from running the largest men's shelter in North Carolina to multi-million-dollar investments in affordable housing development and much more in between. Thank you so much to you both for joining us today. And Jessica, you can take it away.
Awesome. Thank you. I'm super excited to hear Lorena's presentation too. What an incredible bio that you have. Okay, so I'm going to start sharing my screen and my presentation here. I hope everyone is doing well on this short week. I think that this is such an incredible market, but it's very, very difficult for members. And it is difficult because there's really no inventory. We have seen really incredible demand in the last year. Really, we saw a plummet in the market as lockdowns happened, as states had restrictions on what could happen for real estate activity. But then immediately following that, as people were in their homes for about a month, the demand really hit. I will say this is a very uneven recovery. This is very much a K-shaped recovery, meaning the top half of the K are the folks who could bring their laptop home, had the luxury of working from home, had to deal with that with young children and many times with aging parents in their home, but were able to move forward. On the bottom half of the K are folks who had cut hours, who still are not recovering, even as states have reopened, even as the vaccine has been pumped out and people are feeling more comfortable going into stores. We really just don't see the full economic activity that we did see before the recession and before this pandemic-led recession. So I'm going to jump into what we are seeing in the housing market, some changes we're seeing. I'm going to talk about folks who are being left out of the housing market today, and then I'm going to talk about some changes we're seeing. So that's a little roadmap, and I will hand over my slides afterwards, so you guys don't have to furiously take notes. So I think we're all in this pressure cooker situation with COVID. We have felt that for the last year, whether it's anxiety of reopening right now and anxiety of having to have the small conversations and talk to folks at happy hour after not doing that for a year, whether it's the anxiety of schools and kids and what in the world do we do with them, hybrid method, in-person method, what's going to happen for the fall. There's a lot of pressure on families right now. And with that, what we have seen is that we're seeing incredible home sales activity. We see a lot of buyers in the market. We have no inventory to actually really support the buyers who are in the market right now. Homes are moving incredibly fast. It's 20 days from the typical list time to contract time on a national scale. I will say that's probably laughable in so many markets. Yes, okay, I'm getting the laugh already there, because really we're seeing probably a day or maybe 2 days, at least by the weekend, you have a contract on that home. The month supply that we have on a national level is 2 months supply. The real supply is lower because that includes pending contracts. And we know that once it goes pending, those homes are not available for consumers. It's not likely to really bounce back into that market. We have more than 100 months of year-over-year home price growth. This is unprecedented in the length of time. We have never recorded this length of time of home price growth. Unfortunately, what that means is that you're losing a lot of buyers in that market. You're losing those first-time home buyers. You're losing the people who cannot have an all-cash offer. A quarter of offers today, a quarter, are actually all cash. That is insane. Like, I can't underscore that enough to think that you really are talking about people who are quite well heeled, who are quite wealthy, who can compete in this market compared to those who really cannot compete in that type of environment. People who feel comfortable waiving the contingencies because it doesn't matter to them. And they really can throw the cash at the home if they need to remodel it once they get in. We have seen year-over-year home price growth in 99% of the MSAs that we're tracking, 99% truly. There's only one MSA in the country that did not have year-over-year home price growth. That statement in alone is really unique to this time period. We had seen pre-COVID, sure, Boston, New York, San Francisco, LA, all of those markets always hot, always had year-over-year home price growth. Now we're seeing it in secondary markets, places where CEOs are now saying you can work remote. You do have the flexibility to do that. And so people need that family support right now. They're going home to where they may have grown up. They're going to more affordable markets that have good broadband access. So why not move there, where I can buy a single family house, have a big yard, and just know that I will have a bigger place where I can have my own Zoom office and maybe 2 home offices, as well as the bedrooms that I need within that house. So this is really switching up the market and what we're seeing. All of that being said, we're leaving a lot of people behind with this. We have historically left a lot of people behind. It's incredibly important for us to recognize the homeownership rates in this country and to look at them by race, because it is a pretty stark measure. So I am going to go there. I'm going to talk about this briefly, and then we're going to talk about who is entering the market today. When we look at the homeownership rate by race, what we do see is that there is as wide of a spread today as when the Fair Housing Act was started in 1968. That widening of that spread between the Black-white gap in the homeownership rate has actually widened over time and widened in recent years. We see that white Americans have recovered from the Great Recession that we saw a decade ago. Their homeownership rate has risen to 73%, while Black individuals in this country, their homeownership rate is at 42%. Unfortunately, that has declined in recent in the recent time period following the Great Recession. And there's a number of reasons behind that. And I am very, very briefly talking about this because of all of the systemic issues within homeownership. It is important to note that this is a generational passing of wealth, a generational passing of knowledge that is being left out. And we do see this has been exacerbated because of the pandemic as well. When we look at recent data, what we can see is that even among successful home buyers, those who did purchase a home in the last year, 10% of Black African-American home buyers were actually rejected from their mortgage application compared to just 4% of white Caucasian home buyers. That's 2.5 times. And these are among successful home buyers. These are the home buyers who did say, you know what, I do qualify. I do have the money saved. I am able to purchase a home in this market, and I'm going to go forth with that. These are not the home buyers who are being left out and are then going into that calculation of that homeownership rate and seeing that stark divide. And why does this matter? At the end of the day, home is not just where we're spending so much of our time today. even as the economy reopens, it's also where we have our nest egg. It's where we build our net worth in the US, and it's where we pass down generational wealth to next generations. And what we see is for white families in the US, they have $188,000 in net worth compared to just $24,000 for Black African American families. And that again has widened over time, really mirroring that homeownership rate and what we have seen as well. All right, so let's talk about who's entering homeownership. What we have seen is that absolutely changes have happened in the last year. People need the more space, they need a bigger yard, whatever they need from their home, that has happened. But people who are buying homes have actually changed as well. We're seeing people who have higher incomes, they're purchasing at those higher price points. We actually see that homes that were purchased over $500,000 actually increased to a quarter of homes that were being purchased during the pandemic versus in the teens pre-pandemic. We also see that buyers have a different expectation of what their home is going to have during the pandemic. We actually saw that people are saying, you know what, I'm buying my home for right now. This may not be my forever home. This may not be the home that I retire and age in place in. I'm going to need this home for about 10 years. And that's as a median versus 15 years for pre-pandemic buyers. And that's quite the change that we have seen in recent months. The other thing that we're seeing is that people, at least pre-Memorial Day, I will say this, maybe I need to edit the slide, were actually purchasing their home sight unseen. They didn't necessarily feel comfortable jumping on a flight. The inventory is incredibly tight. And they said, let me just see the photos, let me see the Matterport, let me see the videos, let me do the virtual tour, and I will actually place an offer on that home. Now, I don't have very recent data on this, and I'll be very interested to see if this continues because of the inventory shortage versus pre-pandemic and reverts back to just 3% of buyers purchasing in that method. We're also seeing that people are being very strategic in the homes that they're seeing. There's not enough inventory, and there's not inventory in particular price points, especially at lower entry-level price points. And so we're seeing that people are just seeing fewer homes before they do put a serious offer on that because they have to move fast. The other thing that we're seeing here is that millennials are in the market. There has been a lot of talk about this of late, and they are here. They have been here for more than 5 years as the largest share of buyers. Their homeownership rate overall is lower than what we see for past generations, but they are here as buyers. A lot of them have mom and dad's money. A quarter of young millennials are actually relying on mom and dad's cash to place that offer on that home. But we also know that millennials have taken advantage of the opportunity in the last year to move home, not pay rent, or at least not market value rent, and then save for that down payment, pay down that student loan debt, get their debt to income ratio in check, and be able to enter the market. That gives them some leeway because they're not matching up rental terms. They don't necessarily have like a strict timeline, and they can play in that market, that home buying market in a different type of way. Gen Xers, largest share of multi-generational buyers. I'm going to go back to that because it's such an important point right now. And boomers holding a lot of wealth. They have the highest share of sellers right now, which becomes this very interesting generational dynamic between the millennials, who are the largest generation of buyers, and the boomers, who are the largest generation of sellers. And that dynamic, I think, becomes very interesting as we do see passing of wealth between the boomers to the millennials. But we also see that those boomers are not downsizing. They're purchasing homes that are actually the same square footage as what they had lived in before. And they don't necessarily want to leave that square footage behind. And that's an interesting dynamic as well. All right, so Gen Xers, this is an interesting generation. They are a small generation. They're wedged in between the two mammoth millennials and boomers. And they are often left behind in the conversation, but I do think it's important to focus a couple of points on them. One, they're most likely that they had been underwater. They had bought their home during the Great Recession, and they lived in their home for a longer period of time. The other thing that we see for Gen Xers is they were most likely to actually have a distressed sale in the past and now come back into the market. So they're a little wary. They're going to take a little time to really figure out what they need. The other thing is that they are in their peak earning years, meaning they're making the most money and they're buying the most expensive homes, but they also have a lot of family pressure. Kids under the age of 18, and 18% of them 18% purchased a multi-generational home, a place for aging parents, a place for kids over the age of 18 who have boomerang back. This is a very, very unique generation and a very unique dynamic with that. When we talk about multi-generational homes overall, what we have seen is there has been a very fast acceleration in these types of homes. Aging parents moving out of senior centers, assisted living facilities, and are now in these family members' homes. It is actually 15% of all buyers among all generations. So that's a very interesting increase, and it has increased from 11% before the pandemic. Seeing these aging parents in the home could be because they're taking care of kids with closed schools and daycares. It also could be for their own safety precautions during COVID, with nursing homes closing, and really having big restrictions among visiting family members. But something that has very, I think, has changed in the last year is that there are indications that these family members are here to stay. They're not going back into nursing homes. They're not going back into assisted living. They're actually in this family member's home permanently. And that is a big change. The housing stock in America is old. It does not necessarily support this change, but it is something that these families will need to grapple with and think about remodeling moving forward, just to have bigger hallways, bigger doorways for walkers to go through, guardrails and bathrooms, any type of safety procedures like that. The other thing that we're seeing is that families are pooling money to buy a larger home together for cost saving purposes. And we also see an unprecedented number of young adults at home. It's the largest share of young adults who are living at home today since the Great Depression. Truly since the Great Depression. So we are seeing a lot of young adults who can take advantage of this, but also may have had to move back because they lost their jobs, because they had cut wages for some other reason. Now, they could be going back to college in the fall. They may be back at college now in some sort of hybrid method, but this is a unique time period to have all of these generations converging together. All right, so this trend that I'm moving on to here, this drop in birth rates, this has been talked about quite a bit in the media in the last couple of weeks, because we hit a century low in birth rates in this country. This is affecting housing. This will affect housing. It has been affecting housing. This is not just a blip on the radar. This absolutely is a trend that has been happening for a very long period of time. When we look at home buyers who had a child under the age of 18 in their home, 58% did back in 1985. And now it's just 33% of all home buyers have a child under the age of 18. That is a very, very big change, and a very big change in what people need from their home, where they need their home to be, the importance of schools and school districts, convenience of schools. All of those things are off the table if you don't have a child and you have no intention of having a child. Perhaps those extra bedrooms for Zoom rooms now, for home offices, but not necessarily for having that as a baby's bedroom. And that is a big change from what we have seen in recent years. The other thing that we're seeing in the last year is pets are big. They are big money. They are a big driver of consumer behavior right now. And we are seeing pets make the decision. Truly, in home ownership and where people want to live and what they need out of their home. I know this is a very late topic, but the cost of a dog has gone up more than 100% in the last year, and the cost of a cat went up more than 40% last year. There's a massive clearing of the shelters. There's indications now that shelters are now receiving the pets back. Unfortunately, that's definitely sad. But we are seeing that this is driving home buyers and what they actually need out of a home. Especially true for unmarried couples and for single females. A very big driver for millennial home buyers of where they want to live and what they need, close to the dog park, fenced yard, all of those things that are, of course, that's important to a dog owner, are becoming even more important now. The other big change that we're seeing here is a drop in marriage rates. This is not getting as much press as that drop in birth rates is, but I would say equally important when we do look at home buyer activity. When we look back at the 1960s, more than 70% of American adults were married, and today just half of American adults are married. That is a dramatic drop in marriage, either people walking away from the institution, a graying of divorce that we have seen in this country, but also we're just seeing people get married at later ages, and millennials aren't quite at that age where they are now getting married. And so we are seeing all of these trends converge at once with this drop in marriage rates. Now I'm hearing all the fodder that we could have this wedding boom in 2021 and get ready. You're going to be going to a lot of weddings. Very possibly true, but right now at this exact moment, we're not seeing it yet. What this means for home buyers is a difference in affordability. It means a difference in buying power, because if you have more single adults, that's one income competing against these married couples who are putting down all cash. And that becomes a very interesting dynamic too. The other thing that we're seeing here is that single females in recent years actually have declined. And I think that's due to affordability, because single females really were a powerhouse in the home buying market in the past. They were 27% of all first-time home buyers. Today, it's just 19%. What we have seen is an increase in unmarried couples in the market purchasing a home together. And we've seen an increase, especially in the pandemic, of roommates purchasing homes together. So maybe they were renting in the past, they decided to pool their incomes and really buy this house where they don't necessarily have to be in the city center, but they own something now with these very, very low interest rates. That's a very big change that we have seen. What I want to know for both of those is that if that unmarried couple breaks up, if they don't necessarily stick together, or if that roommate breaks up, maybe someone gets another job or they do partner up with someone else, what happens then to those homes? And I think that's something to watch moving forward. Maybe all those unmarried couples are going to get married in 2021. I don't know. All right, first-time home buyers, this is a big drop as well. We have seen them only this low when we had double-digit interest rates back in the 1980s. They're now only 31% of first-time home buyers, really having a hard time in this market competing, really having a hard time competing against these all-cash buyers, even seeing first-time home buyers in some instances putting down all cash, perhaps mom and dad's cash, to enter this market. That's an unfortunate storyline and something that we have seen, because you just see this very wealthy competition among buyers. Student loan debt, massive question mark here. In the last year, there's been some alleviation in that you had federal student loans go into automatic forbearance, and you had a 0% interest rate for federal student loans. That's a big leg up if you were gainfully employed and you could actually try and tackle some of this debt without having an interest rate attached to it. What we are starting to study right now is to see if that has had an impact in the last year. We don't have recent research on this, and it is a little too soon to see if we're going to see this jump up in young buyers who had the student loan debt. I will say that student loan debt, oops, that is my timer. I'm near the end here. I will say that student loan debt is not just a young person's issue, though. We actually see older millennials who are hitting 40 and Gen Xers, that wedged in the middle generation, actually have a higher dollar amount of student loan debt, though it's a smaller share. And the reason why is they went back to college, they got a second degree, they started again and re-educated themselves, but they also may have debt for their children, especially for Gen Xers. So this is a generation really to watch, but also to know that this is an all generation issue. It's not just a young person issue when we do talk about student loan debt. All right, agent use, I'm going to end it on a good note here. Agent use is very high right now. People want agents, they want the representation. We have been doing studies throughout the pandemic, and what we have seen consistently is that people want someone on their side who's going to navigate this market, who's going to negotiate terms, who's going to find them that perfect home, because it is an incredibly tight market. It's very hard to find that home. And people just want an agent who is going to be able to do that for them at the end of the day and help with their anxiety. There is a lot of anxiety out there, and that cannot be underscored enough, is that people are stressed, and they're stressed re-entering now. They were stressed during the pandemic over their own health, but every aspect of this has been stressful for people. So they do want that representation. On the buyer side, absolutely. We are seeing that 89% of people are using a seller's agent. FSBOs near all-time lows at just 8%. We have data on iBuyers. It was less than 1%. It was essentially zero percentage-wise. And we actually asked a follow-up question, not just did you use a seller's agent, but what type of seller's agent to use, someone who just lists on the MLS versus someone who has a broad range of all the services before that home is listed, all the way to the closing table. And what we see is that sellers wanted someone who has that broad range of services that are being used. They really do want that representation. All right, that's all I have. And I did go over times, but thank you so much for having me. And I will send over my slides as well.
Thank you so much. That was great and really informative. And you covered so much in 21 minutes, but it was really good. Thank you so much for joining us. And I think this is going to couple so well with Lorena's presentation about what we are seeing here in Wake County. So Lorena, are you ready to give your presentation?
I am, and I have lost my video. It says that the host has stopped it. I'm not really sure why, but I'm here.
I'll make you a co-host again. Sorry about that.
No, I got kicked out and had to come back in.
Okay.
Jessica, that was a really good presentation, incredibly comprehensive, and I'm hoping that this presentation pairs well with it. Everything that was just discussed is what we're seeing here locally. I mean, just all of it. So there's a lot happening, right? And there's a lot that we have to be aware of and prepared for and combat if we're going to really see good economic recovery, especially where our housing stock is concerned. So what I'll talk about is just a little bit about what our department does, and then what, well, let me see if I can get this open. And then what we're doing, what we're seeing locally, and what we're doing to combat the effects of COVID-19 here in Wake County. So let me share my screen. Let me get my window open. Yeah. Hopefully you all can see it now. And I'll start my slideshow. All right. Can you all see my screen? Okay, I can't see anyone, so I'm going to assume I've got some head nods there. There we go. I can only see my screen right now, but the way it works here. All right, so just a real quick recap on who we are. If you all don't know, the housing department, as in my bio, really is responsible for just the spectrum of affordable housing here in Wake County. We have 3 distinct divisions, so everything from the development, so think built environment or equitable housing community development division. That's buildings going up, sidewalks going down in areas that can't afford them. Work very closely with all the different municipalities there. It's important that we understand land use policy, zoning, all of that. Homeless and prevention services is really important, was prior to COVID, especially now with the prevention programs that we're launching through our department. We work very closely with folks who are trying to get back into the housing market because they've lost their homes or they're about to lose their homes. And so we have lots of programs there. And then permanent supportive housing is really those familiar faces and folks who cycle through our systems and can't quite stabilize on their own. Our overall goal is to ensure that there's quality, affordable housing available for all Wake County residents. That's a tall ask in a community that's growing as fast as ours, especially when we have such a gap with incomes here in Wake County, as we do nationally, and especially with something like COVID-19 really exacerbating and pushing that gap even further. As you heard, this is a K-shaped economy. And so while we already had a gap, now we're seeing that gap widening. So for those who are already to be able to afford their housing, they're doing a little better. And folks who were already on the cusp or really weren't able to afford housing here in Wake County, it's getting harder for them. And so our jobs have gotten a little harder, but we've ramped up. Some of our highest priority tools prior to COVID-19 were to work on things, like I said, land use policy with our municipalities, leveraging more programs, increasing public resources. And so from our affordable housing plan, this is just kind of a checklist of where we are with those things that we are working on. COVID has changed a lot of this. We are still doing all of these things, but there's a lot more going on now that we're seeing locally in terms of housing insecurity due to COVID-19. The previous presentation talked about the trends we're seeing nationally. Those are all still the same here. But we really worked early on in the pandemic to try to project what the different waves of housing insecurity would look like here in Wake County. And so early on, we kind of broke it down into 4 distinct waves that we felt would happen. Now, these waves have kind of moved, in their space and their timelines because we keep having, extensions of moratoriums and those kinds of things have continued to change throughout the pandemic. Right now, this is kind of what we're looking at. The first wave were really for households who, couldn't access unemployment. They were faced really high risk of becoming housing insecure early on. A lot of these folks were undocumented, borderline homeless. They were employed in the gray economy. They were in our hospitality economy and just really couldn't access those unemployment benefits because they weren't full-time or for whatever reason. And so that was really the first wave that we expected, and that did come to pass. Wave two is, we're expecting when Superior Court and district courts resume, we'll see, a number of folks who still aren't able to pay their past due rent, and then would be at risk of housing insecurity through eviction. Right now, that moratorium is through June 30th, 2021. The third wave are, folks who, have had extended periods of loss or decreased income, but they're homeowners. And when that foreclosure moratorium, ends and the forbearance period ends, there will be homeowners who are not able to resume their mortgage payments or get caught up. And so that's another wave that we've been preparing for. The fourth wave is when we see the expiration of the unemployment compensation programs. Right now, the benefits that are currently being spent here in America are through September 4th. And so short of an extension or an increase there, we believe there'll be another wave once those payments stop. And so we have really tried to be responsive to this in Wake County. And so back in May of last year, so just about exactly a year ago, I wrote House Wake, which is really our comprehensive plan and strategic plan to help us to not only, combat COVID-19 effects in Wake County, but also to try to maximize the long-term outcomes, to try to use this moment to kind of catapult us forward as much as we can, to use this sort of really horrible time to maybe make things better for Wake County residents. There's tons of energy and tons of funding. So in Wake County, in this last year, we have received a total of almost $83 million specifically for COVID-19 that's being used for housing in Wake County. I'm going to pause there on that number because it's massive. We've never seen money like this for housing. And while we know that, it's a huge need in our community, we know there are a lot of folks who are struggling with housing. It's amazing to see the amount of money that we have now to use to help us stabilize these folks. It comes from various different sources. Our department managed, including our development pot, we managed under $40 million when we started. In this last year, we have tripled in size because of the federal funding that has come down and the housing department itself is managing. We rolled out House Wake in 3 distinct phases. The first phase focused on the folks who were in the most precarious situation. Those were folks who were homeless and had nowhere to go. We utilized $11.5 million in federal funding, and we did a ton of things. In the interest of time, I'm not going to go into all the details here because I think you all are going to be more focused on the phase 2 and phase 3. But it's important to note that we made sure that folks here who were homeless and couldn't access housing were able to be in shelters that were socially distanced. We opened 2 full hotels. We wrapped services around people. We were able to permanently house nearly 500 families here in Wake County through all the programs that were launched, not just with ours, but our partner agencies that we were funding as well. And so we not only were working to move people into homes or to ensure they were able to keep their homes, but we wanted to actually use this moment to get them out of homelessness. And so we were able to do that for hundreds of families here in Wake County who are now living in permanent homes. Now, their stability in those homes is another story. We need to make sure they can continue to afford their rent and stay housed. So we moved into phase 2 of House Wake in September. We were ahead of the nation because we had launched an eviction prevention program, as luck would have it, a few months before COVID-19 happened. We sort of had a framework to go off of. And so we took our eviction prevention program and kind of put it on steroids and said, if we have all this funding, what do folks need to really remain housed and stabilize in their housing? And so we have a really robust eviction prevention program here in Wake County. We partner with Telemon Corporation as our administrator, and we have 3 distinct interventions for all the renters here in Wake County. The first is if you are facing an eviction and you have a debt that's owed to your landlord, we utilize the COVID-19 relief funding to not only pay that back rent, but now under its current design, we can pay 12 full months of rent as long as you qualify for the program. And really, you just need to be under 80% of the area median income at this time due to the funding source. And you have to have some kind of a loss in income due to COVID-19. And if that's the case and your landlord agrees, Telemon can work with you, an online application to get your debts taken care of and to make sure that you're stabilized going forward for a total back and forward of 12 months. If for some reason landlords don't agree to that, and we will see this likely more when the eviction moratorium ends, we did ensure that all of our renters here in Wake County have pro bono legal services through a partnership with Legal Aid. So Legal Aid will represent any tenant who is denied under the Intervention 1 of the Eviction Prevention Program. They'll be there in court with the tenants, but they're also given some money to negotiate with landlords at that point as well. If the landlord says, okay, I really don't want to go forward, I want to make this work, they have some funds to be able to negotiate. It's important to note they cannot negotiate a better deal than what the landlord would have gotten under intervention number 1. And then there's relocation assistance. If for some reason we cannot come to an agreement, we don't want those families to become literally homeless. Our shelters are full here and across the nation. And so rather than have them end up on the street, we want to make sure that we move them as quickly as possible from their current home into a new home. And so we have a team that's working on relocation assistance to do just that. And we have a team of housing navigators as well who are working with landlords and property management companies to kind of keep track of the vacant units and the landlords who are willing to work with our clients. And we can even go into the database and filter by barrier. And we can say, okay, I've got a woman with 2 children, needs a 2-bedroom apartment. She's got bad credit. What landlords would be willing to work with her that have a vacant unit now to help us move more quickly? All of that was funded through the HouseWake program. This phase is incredibly important because it's not just for renters. It's also for the homeowners that are renting their units, the property management companies as well. About 1/3 of our stock here is owned by corporations, but that means there's 2/3 that are just owned by people that may only have 1 unit or a small complex. And they can't really afford to wait until a moratorium ends to pay their bills. So we were incredibly grateful and happy that the CDC put the moratorium in place to ensure that renters would not be displaced. But we needed to make sure that those property managers and the folks who own these buildings also were able to hold on to those properties. If you think long term, it will really hurt our market if we allow them to go into distress, financial distress and or foreclosure, because chances are, based off what you just heard, if they sell, they're going to sell to the highest bidder in this market. And that means that these units will never be affordable again. And so it's been very important to us that we push out an eviction prevention program that supports our landlords as well and makes it as easy as possible for them to recoup their loss. And so we have done that. There's about, just so that you all know, about 79 million once we pull all the funding in that we're still waiting on that will be specifically earmarked for eviction prevention. So there's a ton of money for landlords and tenants right now. Phase 3 of HouseWake is currently under development. It's going to focus on the impending wave of foreclosures ends that we believe are coming. Right now, there's a ton of money that's been pushed out through the Biden administration's American Rescue Plan. In North Carolina, it looks like these funds are going to be administered by the North Carolina Housing Finance Agency directly. While some of their eviction prevention funds came directly to local government, it looks like their foreclosure prevention dollars are going to be kept at the state level. Housing does have currently 1.6 million in CDBG or Community Development Block Grant funding that we're holding aside so that we can look at the program that the state rolls out, assess it for any gaps that we're seeing locally, and then use that funding to fill those gaps here so that we can ensure we're really trying to create the most robust and supportive environment for our homeowners. There's additional funding that we're seeing coming from both local government and likely from the federal government that will be able to pair with this to bolster that 1.6 million. That's just what we have currently in our coffers for this purpose. And then housing also rolled foreclosure prevention into Wake County's new affordable housing program that launched in April. This program was already planned to be designed and launched, but we thought it was important to kind of add foreclosure prevention onto it now, so we had something on the ground right away while we await the state's decisions and the launch of their program. And so this program is to promote wealth creation. And we heard about that in the previous presentation, how important homeownership is to that. But we know that right now that dream is just really unattainable for folks who are lower income. And so we have this program now that offers forgivable, no monthly payment loans and low to moderate income households. We partner with DHIC as our program administrator, and they're providing essential home buyer education and foreclosure prevention through the program. And so there are two products that have a really impactful outcome. The first is first-time home buyer assistance, and homeowners need to be at 80% or below the area median income, and purchasing their first home, and then foreclosure prevention as well. And so there's funding there for folks who are facing foreclosure and are low income as well. It's important to note that for this program, the city of Raleigh and the municipality of Cary are excluded. This is not a decision that we make in-house. It is because those two municipalities are their own entitlement communities and receive the same funding that they can create a program like this with. So we cannot overlap their communities with this funding. Just some of the details for you all to know about with these programs. The loan amount is up to $20,000. The maximum home sales price is $275,000. I know, difficult in this market. There's a small origination fee, really good terms. You've got to have some kind of a credit score. And really this is because, again, this was designed before COVID-19, and it was just to kind of get our feet wet in this market. We are going to be growing this program. And now that we have more relief funds that give us more flexibility, chances are coming to us. We're looking to sort of dig deeper to lower credit scores. We'll be looking to do more home buyer education. We'll be looking to help people get more prepared for these programs as we go forward. This was kind of just our first dipping our toe in the water here. We've got a number of banks that we're working with here, and we're excited that there are more that are becoming interested in the program. Some of the limitations that we have and some of the challenges is, number one, is just the supply. I mean, homes under 275,000 were hard before COVID, and COVID has really, really pushed home prices here just to the max. Some of this is driven by the amazing loan opportunities that are out there with really low interest rates. Some of this, again, is being pushed by the K-shaped economy, and some of it's being pushed by investors who are coming in and saying, okay, well, I can buy up as much as I can right now with really great rates. And so they're buying multiple properties. And so competition from investors and rental properties is really tight. And so due diligence is really difficult right now. Folks are paying just incredible due diligence amounts just to get the property they can afford to, especially as we heard earlier, there are so many all cash offers. And so that's incredibly hard. And these loans just take longer. And the market, as we heard, is moving really, really quickly. And so these are some of the things that we're looking to address now as we push this design of this program forward. We also have our homeowner rehabilitation programs. We've had these programs for a long time. We believe they're more important now because folks have less disposable income. And so we really want to make sure that we keep residents in their home. We've been really fortunate that we've experienced so much growth and prosperity, but there are a number of folks who, are kind of being left behind with this. And for our elderly population, who may have lost, some income, maybe they were doing a little bit of part-time work, and a lot of times that's in hospitality type industries that they may not be doing right now because the business may have closed or cut back. It's really difficult for our elderly population, and it also is really unsafe for them to be kind of out, in the general population, is with so much COVID, right? Now we believe that, it's getting better, but for a long time, we were really concerned about our elderly residents who were trying to find any kind of work to make ends meet, couldn't find it. And now they're, out in the public a lot more than they probably should have been, because we knew that they were at a higher risk for really bad or really negative outcomes for COVID-19. And so this has been a really important program. Our emergency grant is one-time assistance for up to $5,000 for repairs. So folks who were in this category, who were low income and elderly, but they had, heating systems, wells, septic tanks, roofs, the big things that they just couldn't afford to fix before COVID, and certainly during and or after. This program was there to help them kind of get over that hump and take care of their needs. And then for our elderly and disabled grant program, this is up to $20,000. And this is with mobility retrofits, modest repairs for handicap accessibility. Obviously, there's age requirements to this, so 62 years of age or older, and the household cannot exceed 50% of income. But it was really important that we bolstered these programs during this time as well, and so we put additional energy and finances into those programs. Some of the program challenges is just contractors. With all the development, with all the flipping that's happening here, I mean, it's just hard to find contractors. Maximum tax values have gone insane. The cost of repairs, lumber is more, steel is more, everything costs more right now. And then just the condition of homes, the homes that meet this criteria in terms of value are now typically, in much worse repair than the ones that we were seeing before when home values hadn't yet skyrocketed. So again, COVID in and of itself is affecting this program. And then just the timeline for completion, because some of these things are harder to get, take longer for shipping, finding contractors takes so much time. We're really seeing a challenge there just to get these projects completed in a reasonable amount of time. And so it was really quick, but just a little bit about the waves that we're seeing here of housing insecurity, and a little bit about what we're doing to try to combat some of that now. I'll stop sharing my screen. I will make these slides available after this meeting, and you all can reach out to me at any point in time. My contact information is there.
Thank you so much. Thank you to you both. That was so well-rounded and you covered everything. I'm not sure how many questions we're going to get because you guys were so detailed. Lorena, you did mention that you have more energy and funding. There's obviously gaps in inventory and contractors and the lumber prices, but are there any other gaps that are creating new obstacles for you guys to overcome with all of the funding and energy behind your efforts?
Yeah, I think our biggest gap is partners. I mean, even our partner agencies that a lot of the work we don't do directly, we partner with agencies and we're the funder, but they're stretched thin. So, in our homeless system, those agencies only have so much capacity, even though they're trying to hire and, ramp up. In our contractors and developers, they only have so much capacity, and we know that this is kind of the moment that we have to move now, right? We have to try to grab as many, units as we can now while they're still relatively affordable, as much land as we can now while we still have some land to do that. But it's partners. It's finding the partners that we can do that work with. And so we have really been pushing to have more of a national presence and try to bring new partners here that can do that. And then really asking our current partners what it is that we can do to help them grow as quickly as possible so that we can try to meet the need in the community. One of the other big barriers is really just the amount of time it takes to get to funding. One of the things I didn't put in the slide because it would take a while to explain is our acquisition and preservation funds. You'll hear more about that in the coming months. But we are pushing for a new way that folks can access these dollars that doesn't require the red tape of government and essentially is a community bank for affordable housing development. And so that will be on the ground relatively soon, and you'll have more information to come.
Thank you. Jessica, you were talking about your studies, and I know we're not completely out of the pandemic, although we were joking with Lorena before we went live that it does seem like we are jumping right back into things. When do you think you'll see the true impact that COVID has had on housing? Does that happen in a year? Does that happen in 5 years? When do we see what those numbers really look like?
Oh, goodness. That's such a big question. So I will say that we are releasing data every single week. Every Thursday, we're really tracking the pulse of the housing market. And then we do have monthly releases as well. I will say the home buyers and who they are and who the home sellers are in the last year, we'll have a very good idea of that come November of 2021, maybe October. It's when we release our annual profile of home buyers and sellers. And so we send out a massive survey. It's 8 pages long to recent home buyers and sellers who purchased in the last year. We're looking at primary residence buyers. So it's not going to be the investors out there. It's not going to be the vacation buyers. But we will know then how much we're looking at for a drop in first-time home buyers, how much we're looking at when we look at the changes in birth rates and we look at the changes in marriage rates. So that's a really good take on who is buying now.
For both of you, when you started the pandemic, when we started March of last year, what did you predict was going to happen with housing? What were your thoughts when it first started? Because I think we all were nervous that the opposite was going to happen, that people weren't going to buy homes, weren't going to be interested in doing all of this. So it's gone completely the other direction from what our initial gut reaction was.
Well, I'll say that I had a conversation very quickly, and I I said, I think this is going to drive consumer behavior, that they have to move. And the reason why is I was sitting at the kitchen table and I really didn't have a home office at that point, and I did not have a space to work, and my husband didn't have a space to work, and my adult sister who's in her 20s did not have a space to work. And we're all jockeying for where can we take a conference call? Where can we get on a Zoom, which we didn't know how to use? And I said, this is going to drive consumer behavior. And now I've just completely remodeled my house because it had to work better. We had to make it function for the last 15 months. And so we didn't kill each other, which we haven't. We're all alive. So that's good.
That is good. Yes, lots of changes. I got married during the pandemic and was trying to work at home in a little apartment. So we also had to make a move. So you were definitely right on that. Lorena, what were your expectations?
Yeah, I had kind of similar expectations. And it's funny because people thought I was crazy when I was saying this is actually going to make things move faster, right? We need to move now. And that's why, it was April when I started talking about we need a strategic plan. We got to look at what we're going to do about our stock here. It's about to move. And so we drafted House Wake back in May for that reason. But one of the things that I was really worried about was, I knew there were going to be, crazy low interest rates. That's what the federal government does, right? And so when you see that, you see more investors and people. This is the K-shaped economy, right? People who can take advantage of those rates, come in, snatch them up. And we were already losing so much land and so much property to investors in Wake County. That was my concern, that we were going to lose it at a far more rapid rate. And that is true. That's what's happened. And so, I don't think this market is surprising for those of us who are really kind of in the trenches of this work. But I do think that the speed at which it happened I was a little surprised by that. Like, we knew it was coming, but it was just overnight. And so just kind of watching that has been a little scary, but it's been good to see the federal government step up and really push funds to help us out there. And it's been really good to see the energy and the excitement behind really the community wanting to do something about this. And if there was anything that COVID could have helped us in any way, right, it was to shed light, I think, on how many people have been on the cusp and didn't even know it. Right. I think before the pandemic, if you were doing what your financial advisors told you to, you would save 6 months, right? Make sure you've got 6 months in reserves, and that way, if anything happens, you'll be okay. Well, what happens if it's a year? Right. I think folks are learning that it's not really us versus them. It's all of us. And whether or not you end up on the tough side of things really is nothing but, time and circumstance. Right. And so it's been interesting to see folks who never would have been interested or thought they'd be in the space before end up in the space or be interested in supporting folks who are struggling right now.
Yeah, I mean, I think for us, we have certainly, as an association, taken a look at different areas that we wouldn't have before, and that's including the racial home ownership gap and bringing some of that change here, working with you, Lorena, on how we can address that here. And I know your work is so great and is doing so much for our community. And I know you have the complete support of the county commissioners, all the ones that we've talked to at least, and everyone always sings your praises. And I'm so happy to hear that you are all of the work that you're doing. Thank you for taking time to share that with us. And thank you so much, Jessica, for jumping on and sharing all of your information with us. We see these headlines all the time, but it's good to hear the numbers behind it and what everything actually means. So we all appreciate both of your time, and thank you guys so much for joining us. Again, everyone, this is going to be available online for all of you guys to see, and we'll share the slide decks with all of you as well. Tim, do you have any closing remarks?
No, I would just like to thank both of you for your insight. It is very, very, very helpful. I can't say I'm surprised at anything you shared with me. It's interesting to see the national statistics of percentage of buyers that are married and multifamily, and it's eye-opening because we don't really look at the market that way. Now, just a little snapshot here in Raleigh. I've got a listing that is coming soon in Southeast Raleigh, priced at $235,000, 3 bedrooms and a bonus, and a 1-car garage. And I've already received, showing start Friday, I already have received 3 sight unseen offers from investors, and I have a total of 45 showings scheduled already. It is an absolute frenzy. So that's the reality out there in this market.
Yeah, I mean, that's definitely something that is driving up these prices, this inventory shortage, these investors coming in. I know that's making it difficult for people my age, but there's a generation younger than me that's entering the market as well. So it's problems that we are definitely looking to partner. We're looking to be one of those partners with Wake County and helping solve these issues here at home, making sure everyone has the opportunity to be a part of the American dream. We did get a question. We were just wrapping up, but we have time for one question, if that's okay with you guys. Investor buyers are huge in our market, she says, but maybe not everywhere. Is NAR watching market differences? That number you use seems very low. I think this is for Jessica.
Yes. So we do track different markets. In fact, we actually built in the last year a state and local webpage. So in the slide deck, there's actually a link to that. And we're watching it in different ways. So one is taking USPS data and change of addresses. And we're actually seeing where people are migrating to and from. And there's going to actually be a new release within the next couple of weeks on that. So definitely watch that. The other way that we're doing this is taking ACS data, so census data, and we're looking at different markets as well. The investor number is hard to get at, I have to say. And the reason why is because there's a lot of people buying in vacation markets. There's a lot of people buying investors who are in those markets, but it's hard to fleece out. Are those people purchasing for their own needs of Airbnbs for partial of the time, and then I'm going to stay there for partial of the time? And what's going to happen as the next year starts? Are people going to go back to their primary residence if they have a condo in the city? Are they going to stay there? And it's very hard, I think, in this exact time frame to parse out who are investors, who are vacation buyers, who are people who are there temporarily and then will stay there. So I think that's a really big question, but one we don't really have a very solid answer on, of what exact markets we're talking about right now. I will say on
It's
good,
so
sorry.
No.
On anecdotals of what in the world's going on with supplies, I am remodeling my bathroom right now. So I'm in an Airbnb myself in the Poconos. And my contractor called me on Monday, holiday, but regardless, and he's working on the house all weekend long. And he said, I can't find paint. And he said, within 3 counties, there is no 1 gallon paint cans. There are 5 gallons and they're all glossy. And that is not what we need for your house. And he's like, I can't find them. Another contractor, so same contractor, he had one of his guys drive, I live in Arlington, Virginia, all the way to Hampton Roads. It's about a 3-hour drive to get tile. So, and I literally said, I don't care what tile, I don't care what color, I just want to go home at this point. And I just want you to be done with the job. But regardless, the supply issues are very, very severe. So it really is an issue for remodeling, for contracting, for building. It is a very, very big issue right now.
Yes. Yeah. I'm seeing that in my remodeling efforts as well. It's a lot of fun for sure. We did get one more question, and this will probably be our last question. The question was about loans being approved and the different rates of why different demographics were being denied loans. So the question is getting at directly why were more white buyers approved and than non-white buyers.
Yep. So we have a report called a snapshot of race and housing, and we actually have a laundry list of reasons why people think they were denied. I have to say, though, it may not be just actually putting in an application and being denied from a mortgage. Those people actually were who filled out the survey. They actually did have an application. They were denied. They were denied, they think, for a specific reason, but you don't actually have to tell someone why you're denied. So debt to income ratio, whether you have cash in reserves, your credit score, whether you're an independent contractor, so you can't verify your income, all of those reasons factor in. But then there's also the knowledge that we have from academic research. What about callbacks? Are you being called back based on your last name? Are you being actually called back from that lender? So that's what's not collected, unfortunately, in that data. And I will say the big glaring piece that we're missing there is we're talking about successful home buyers. We're not talking about the people who never called a second mortgage broker or mortgage lender. But definitely, I would encourage checking out that report. It's a pretty incredible piece of research, the snapshot of race and home buying in America.
Yes, we'll share that. We've been looking at that on our advocacy team quite a bit. It's really interesting, all of the numbers that they pulled. And I have to say, it's really interesting where you get your information, like looking at post office records and change of addresses. It's fascinating, all the different places that you pull from to get the numbers that you're sharing with us today. Well, with that, I will wrap up. This is my second wrap up, but thank you guys so much for joining us. All of this will be available to all of our attendees and our GPIC members. We really appreciate everyone's time, and we'll follow up with everyone. Thank you so much, ladies.